Hello everybody, welcome to the live stream. If you're watching a rerun, I don't think there is anything of value in here. We're just gonna watch FOMC meeting and see what we think about it. We're gonna dump or pump, so there's that. Won't be doing too much TA or stuff like that, so if you're watching this live, enjoy the show. There we go. I don't think there is notifications. Mlad and Petrov. Hi man. I don't think there is notifications for this video, so only people in the know will know. Maybe we should shield it on. By the way, our long position is still open. We came very close to getting stopped out up here at 0.86. So we are, but we are sticking to the guns. So we're gonna try to see how far we can actually push this. I'm already accepted the fate that look here, hold 10,000 bit to enjoy 0 maker fee. So you can actually have 0 maker fee, meaning limit buys and sells, maker fee. Nice. Just hold 10,000, 0 maker fee. Nice, that's very nice. But unfortunately we need to, maybe when we are selling we can get, a lower maker fee. How much is 10,000 bit right now? How much is 1 bit? Bit DAO 0.4. Yeah, so you need like 5k to get 0 maker fees. So there is that. Okay, let's go to Twitter and announce on Twitter that we will be doing this show. Twitter, and on Twitter we'll post the link and say live. Let's just copy the watch it live and chat about it. Okay. Little smile is okay. There we go. There we go. I shield the stuff, whatever I can shield the stuff. Okay, we two can talk to each other. Yeah, it's okay, man. We don't need a lot of people in here. Do you get stop hunted? Nah, not yet. We are back above this, this trend line up here. Now this trend line seems to be wrong for whatever reason, so we're gonna adjust the trend line. I don't know, let's keep the trend line. Let's just go to bigger time frames to see this. 15 minutes time frames. It's kind of it's not actually on the dollar. It should be up there. There we go. This is a better one. This looks like channel, so I think I might get out. I think I might get stopped out though. If you look at this channel up here, it is, we went up, went down right now up. So if you do another move towards downside over here, I'm definitely gonna stop out. So right now, best option is here, coming very close up here and then breaking this towards upside up here and going up. So but I do wanna let it go because I think this can go actually higher, a lot higher. So we could have actually pretty nice gains up here. This is all the way up like 77% gains, which is nice, but 100% is nicer. Go to 1 hourly. 1 hour looks very bearish though. We still got 5 minutes left, but we had bearish engulfing candle, Right now we are picking up. So if this candle up here, you know, if we can get, you know, bullish engulfing candle over here, that's extremely bullish. Look at it right now, man. Look at it pump. Look at it. Why is it pumping, man? Stop pumping. Look at it go. Look at it go. Did the news come out already? Look at Bitcoin go, guys. What's happening? Is the news out already? What did just happen, guys? What did we just witness? Look this, man. Look up here. What just happened? We gotta check it out. CNBC. Here's everything Fed expected to announce, including the biggest rate hike in 28 years. The Federal Reserve on Wednesday expected to rise benchmark rates by 0.75%, so 0.74. In addition to the update, its outlook on rates are ahead as well. So it's 0.75. So it's out now, right? Good evening. Exactly what fuck WTF just happened? Yeah, what just happened? Market making building shorts. No. Something just happened big time on Bitcoin, and I do not know what. You know, this move up here was insane move towards the upside. 3 minutes left, but we already got an engulfing candle on our. No, it's in it's in 35 minutes, but I'm thinking, you know, candle closing is in 3 minutes and 34 seconds. So shorts for a dump. But I think it, you know, it should have been already announced. Let's go to Twitter. Twitter is usually fast with this kind of stuff. You know, you just need to follow right people. Original Top Gun, great movie. Just rewatched. Looking forward to seeing the sequel. I mean, the liquidation problem now. This 19 minutes ago. Is this the newest? See the latest tweets instead. Yeah, let's see latest tweets. I don't like when they decide. Fireman says the digital euro could be limited maximum 1.5. Thank me, that's us. Somebody liked that. Nice, we're gonna like that as well. 19 minutes ago. So I don't, you know, let's see if FOMC. Let's see if people are seeing up here latest. Pull myself double now ready for FOMC 16 seconds ago. Just raise it, sold 1% here. Oh baby, it's time to teach in paradise right here. If you are to share desk video trading, hands ready, this isn't for you. So somebody's already ready to pull the trigger. We are already in a trade right now, but you know, right now it's right back down again. I don't know what's happening, guys. The volatility is insane. But we came out of the you know, channel up here. So you know, there's that. But Bitcoin is crazy. Bitcoin is crazy. It's still not above the line though. It's still not above the line, but Bitcoin is definitely crazy. We got 2 minutes left, I think. Let's try to find a stream over here. FOMC meeting. Let's try it, you know. Market Wednesday finance. This guy is watching, but does somebody have a link to the live so I don't have to look for it?
I'm Shauna Smith along with Rochelle.
Where's it go? Day trade.
Friends at the same time. Go for it.
Go for it. Already, this is hot trades. A lot of these trades are actually, you know, streaming this, but you know, FOMC meeting live. It's okay. It's gonna go. The Fed live video. There we go. There we go. This is it. .30 p.m. So in 30 minutes. So we already know where the video is. So I'm gonna watch that in a while. The official Fed link, yeah. So we are on official Fed link on Federal Reserve Government, yeah. Okay, so we're gonna see. The press conference starts in 30 minutes, but right now in 1 minute, you know, there should come out some news. You know, it already, you know, bounced big time. You know, whether this is, you know, I don't think this is just getting out to these guys up here maybe, and then further move towards downside. I don't actually know what's happening. Like, this is insane. It was really volatile move up here. Let's see it in the volume up here. Yeah, the volume kicked in down there. Let's see on Bitcoin as well. Yeah, Bitcoin volume kicked in big time, guys. Big time up here. You know, something is definitely happening right now. Pure technical, not about news. No, it's not pure technical. Like, you know, this went too slow up here. and it didn't even break the line up here. It just exploded towards upside. I mean, it could be technical, but I don't think it's technical. It shouldn't be technical because it is so. Right now 8 o'clock right now. And where do we find right now what's happening up here? CNBC. Bloomberg. Stock bonds rallying. Countdown to the Fed market decision. Latest. Now, where can you find? Damn, dump pump. Unless definitely not take. Come on now. I'm not quite sure whether it's technical or not. You know, I mean, look at what WTF happened, man. What is happening with the charts, guys? What is happening with the chart? It is pushing it towards the upside, though. It is pushing it towards the upside, though. This is one of those times that you know, we entered very nicely, and right now we are going in the right direction. So you know, it's one of those times. So the question is whether this is gonna break this line. This line up here, this blue line, sorry, this yellow line is very important. But right now, I don't know. It's too much euphoria right now. We're just betting that this is gonna go up, and then we're gonna, you know, explode towards the upside. So we're gonna see that. Right now, I'm a little bit unsure what's happening over here. You know, it just goes up, you know, a little bit down. You know, too much volatility right now. It's good that we are already in trade, so we don't have to 0.75. Yeah, but it is expected. Bro, they just announced. Okay, I did not know that. So market's pulling back a little bit, but it's not, you know, 0.75 is expected. This should pump. You know, 1% is not, but 0.75 is expected. Use less move, put pocket 0.60. Nah, don't make me do Fibonacci's, man. So, you know, we could have some kind of huge volatility right now. Luckily for us, we got, you know, down to our stop loss, 4% down to the stop loss. But, you know, if it goes down, it will go down pretty fast. So we are still betting that this is actually good news and it's going to go up. You know, the thing that I'm looking at right now is that, you know, this FOMC meeting last time was, you know, expected, but it was kind of bad news. So, you know, people were actually, you know, happy about it, but, you know, they said, no, but still bad news. But I'm thinking it's going to be a little bit reversed now when it comes to that. Federal zero hike 75 basis points. Is my stream laggy, guys? Några måter är om 28 minuter. So we're gonna see that. But right now Bitcoin is definitely, you know, looking to, you know, pump or dump. I'm not quite sure what's gonna do up here. There are two very nice lines up here. As you can see, very nice, very important lines up here. This is the resistance line that we're trying to break. Let's make this line a little bit better, because these wicks on the upside is not actually, you know, confirming, you know, the move up here. Maybe it's something like this. Yeah, this looks nice. And the bottom side, this up here has been, you know, steady. So it does look like some kind of channel maybe down here. Maybe some kind of channel we are in right now. Pushing it a little bit on the downside right now, back towards support. So I'm guessing it's not good, guys. I'm guessing it's not good. It looks like it wants to go down. Sand is still, you know, pretty much up, you know, so we are still surviving. The question is, you know, do we take profit? I don't know. I think this is right now, you know, this first initial shock of this, oh my god, 0.75, until they figure out, oh, it's expected. Because I read like several places that they are expecting 0.75. I think everybody was, you know, market has priced in 0.75, so it is 0.75. It is bad for economy, but what he's gonna say in a half an hour might be a little bit bullish, but it might not as well. So this is really, you know, this is really tricky trade right now. But we are sticking to our guns. I think it's gonna be bullish for whatever reason, because, you know, technicals, and we're gonna see how that actually plays out. Sitting on ascent until we have a clear direction. Yeah. So right now there is no direction right now. The price is created this double top up here. See up here, double top up here. Right now pulling back towards the downside. So over here, so might pull back, you know, it might stop us out, and I'm perfectly fine with that, because I think, you know, we are oversold, you know, stuff like that. So we're gonna see that. There we go, we are dumping down again. 1 minute chart over here on sand. Bitcoin right now, it's pulling down back to the support again. it started going up and then right back down again, right? Just like, you know, on the bigger time frames when we had the previous FOMC meeting. Where is the previous FOMC meeting? Let's see how that actually played out. This was the FOMC meeting up here. It also started around 8 o'clock, I think, something like that, right up here. I think it went, you know, in the space and then just exploded towards the upside, right? And this wasn't it. It was down here, right? And then exploded towards the upside. It went sideways and then dumped down big time, and then that was it, guys. That was it. So after this was the FOMC meeting up here, and then went up, you know, and went down and died. So right now the question is, are we gonna start on the towards downside, you know, because we went a little bit up here and then right down. I think people are still undecisive, but you know, right now we are below moving averages down here, so it does look bad. And our sand short is pulling back as well, so I think everything is pulling back right now. I'm still a little bit unsure. You can see big moves here on the red candle. There's not much volume on the green candles, but on the red candle there is a big move. Let's see up here, are we breaking on the downside? We got 5 minutes left to break this level. If you break this level on the downside down here, that can be bad. But right now we are sitting on support, and we're trading right now. I don't want to make any money on trades. I haven't been trading the past couple of days. I've been camping. I missed some good opportunity for shorts. Don't cry over, you know, missed opportunities, man. The market is still here tomorrow and day after and day after and day after. So we are dumping pretty fast right now. I think a lot of FUD is kicking in. We're definitely gonna get stopped out because this over here looks like a, you know, nice, unless we do this down here and then, you know, back up there again, get shorts out, get longs out, and then, you know, go up there again. But looks like he's gonna go for it. We got some kind of support up here, some kind of support down there. There is also some kind of support right above our stop loss, but it does not look good. Bitcoin right now crashing through down on the downside. You know, some kind of hopium there is, but you know, it's very small hopium. So we have a long position up here. Where is it? Long position up here, very close to the stop loss. You can see the stop loss up here. It's gonna touch it right now. There we go. So if something doesn't happen right now, we're gonna get out. Right now we are 16% profit, 15% profit. If right now, see right over here at the bottom, it wants to do it. Bitcoin is down 8%, almost 7.8%, 7.6, 7.7. It's pulling back a little bit. Bitcoin is pulling back a little bit. 7.6, 7.4, 7.4, 7.5. Come on, save us this time, man. Save me this time, okay? Just this time, save me. Don't get us out, man. Yeah, like that. Pull it back up. Pull it back up. Bitcoin is 7.5. Minus 7.5. Let's see Bitcoin down here. It went down to support, so it's pulling back above the support. It got the wick down, you know, got out these people up here. We still got 2 minutes left on this trade up here. It's going back down. It's going back down. We're gonna get out. It's gonna get us out. It's gonna get us out. Are we gonna remove the stop loss, guys? Are we gonna remove the stop loss? Nah, we're not removing the stop loss. We got the stop loss there to save us. Oh my god, almost like $2, 0.3 or something like that. We came very close to that that exit. We came very close to that exit. It's just gonna have a 7.5. Bitcoin needs to do something big now. It needs to reverse. Like, come on, market, figure it out. This is gonna be bullish, man. This is gonna be bullish. Figure it out. We got 2 minutes left. 2 minutes left. Come on, figure it out. Do not get us out. Do not get us out. Come on, a little bit more. Not this time. Not like this. Not like this. I'm betting we're gonna get out on the dollar. It's gonna get us out on the dollar, and then there we go. There. Did you see that? Oh man. And right now it's gonna pull back because I'm bullish, of course. Hopefully it doesn't pull back so we can enter at a lower level. So there is no more point in watching the up here. See here, our long position is still a loss. We still made some money, but it's not much, you know. 1,076. Right now we are at above $1,000. We're at 9,986 bucks. So it is like 14, 17, 70, 80. 90 bucks. We made 90 bucks on the trade. It's not much, but you know, whatever. And right now it's pulling back up again. Yeah, but we are not gonna trade today. We're not gonna trade do any more trades today, something like that. We're just waiting for the FOMC meeting. But you know, anyways, profit. Yeah, anyways, profit. Maybe we can learn something from this. Maybe we can learn something from. We were very greedy. That's true. We were very, very greedy. On the other hand, we did not remove the stop loss. That's a good thing, because you know you don't want to remove the stop loss, because you know that it's data safeguard. You know, once you're up 70%, you want to, you know, that 70% you know, become minus 20%. No, it's gonna ruin, you know, emotionally it's gonna destabilize you. You don't want to do that. Profit is profit. We're gonna learn from it, no problem whatsoever. But you know, there will be emotional damage if this right now pumps to, you know, 1 million or whatever, right? There will be emotional damage. We know that, you know. In the retrospect right now, you know, we could have, I saw the top up here, and you know, it was very nice top. We could exit the trade up here. Let me show you up here. We could have exit trade up here. It was very nice, but I was actually betting on this other line up here, and I was willing to risk, you know, this was, you know, another, you know, 50% towards the upside up here, and I was willing to risk, you know, entire trade up here, even the 70% that we had for that extra 50%. You know, in the retrospect, you know, we lost a lot more than we could have, you know, gotten, but you know, still there's some kind of gap up here happening right now, and still pushing on the downside. Bitcoin is 8.2% on the downside, breaking through the support again. Almost bearish engulfing candle, bearish engulfing, second bearish engulfing candle. Right now, this hourly candle up here, you know, below the support. But you know, it just cannot push any much more down. We're gonna see that out here now. If there, you know, if some kind of nice pattern does come up on the screen, we might trade that, but only, you know, we're not gonna just, you know, jump in over here and start shorting up here or whatever. But if something nice does happen, we see some kind of nice pattern up here, we're gonna jump on that, but only long positions, no short position, guys. We're not doing any short position, but in case something nice happens, in case we see something nice, you know, we might short. So this, you know, went up here to the resistance, failed to break the resistance 2 times, and then, you know, right in the upside direction. But I think right now, you know, market is just waiting for this, you know, FOMC meeting, the press conference. On the flip side, this looks like it's all retail. I can't see any huge transactions. Yeah, retail is very FOMO-ish. You know, it's traders, they like to trade. You know, I think these gamblers, I'm calling them gambler traders. I'm not saying that you are that, but you know, if you are, you know, betting on the news and stuff like that, you know, it's kind of gambling, you know. And I think a lot of traders that are betting on the news, some of them might, you know, bet in the right direction. They get bragging rights, but you know, the best, you know, option is being already in a trade and waiting for the volatility. But this kind of it, you know, up and right back down again. So you got all of the shorts, you know, scared up here, and you know, it came up here, you know, people started going longing, and then right back in opposite direction, so you know, it gets out all of the longs, and right now it can do this, right? So up, down, up, you know, always tomorrow. Yeah, there is always, didn't take any profit. No, we got stopped out, but we did stop out in profit, so it's no problem whatsoever. You know, right now our account is about 1,000, you know, $1,076. You know, it's okay, it's growing. It's not growing by much. It could have grown by more. We could be like at 1.5 or 1.7 or something like that. But you know, it's okay. It's okay. You know, 0.75 confirmed. Yeah, 0.75 is confirmed. But you know, that's not the big news. The big news, because that was already priced in. So even though it's priced in, people are, oh, it's going up, it's going up. It's priced in. We already knew that. I mean, somebody's friends knew that. You know, journals. You know, hear from those friends. And you know, you start at 400. Yeah, we started at 400, so you know, it's not much, but you know, it's getting there. You know, we got time, no problem. Sand up here, and you can see our long position right now is going back up there again. Unfortunately, we got, you know, stopped out exactly on the dollar. So this is gonna burn really hard, like if this goes the other direction right now, because you know, we already had the 2 stop losses like these, guys. I think we had the 2 stop losses exactly like this. We get like stopped out on the wick, and then the, you know, the trade goes, you know, into the other direction, like 50% or something like that. Unfortunately, life can hit you like that, unfortunately. So there is that. It can happen. We cannot cry over, you know, spilled eggs. Stuff happens. We did what we had to do. We tried, you know. The target wasn't hit. It's okay. It's gonna get hit. We got time. No problems. We got 12 months. Market not full. Still nice, 2.5 in a couple of days. It's not a couple of days. We started this actually a lot earlier. When did we start this? When did we start this? We started this. I will do a trade tonight. Is there? I think we started this, 9 days ago. I don't remember. It might be. Here we go. Yeah, 470 bucks. Yeah, we started this 9 days ago. 300 MA incoming. Yeah, a lot of people are waiting for the 300 MA. Trust in the trigger man, guys. Trust in the trigger man. I don't want to be stuck with that man. Hey, you know the trader who? The trigger guy. Nah, that's not gonna be, man. I'm gonna be known for something else, but not trigger man. FOMC could be a trigger for activating the supermoon. Yeah, it could be a trigger for activating. So I am bullish when it comes to FOMC meeting. 0.75 is expected. We are already at bottom. Everything is at the bottom. Like, is the FOMC meeting gonna drop us below the bottom? I don't know. We are not very good at analyzing these stocks and stuff like that. But we're gonna listen to what they have to say. Bitcoin also going a little bit up, a little bit down, like getting everybody out. Everybody beside these guys on the downside, like these guys that bought a literal bottom, they are surviving. They are surviving. Right now hitting this resistance up here. We're gonna see how this actually plays out. 7% down. Okay, see, everything has the same pattern. Tron, how's Tron doing by the way? Let's see an hourly time frame up here. Let's see USDD, USD. How is Tron doing so far right now? 0.7. Wow, it's still going down, man. It's still going down. We need to short. We need short Tron. So let's see up here. I think they are fighting to keep the 50 moving average up here on the 1 hour time frame, 4 hour time frame up here when it actually dropped down. This was going down big time. Did it break the trend? It kind of breaks the trend up here. Yeah, it kind of broke the trend up here, but right now it's sitting up, failing to get back above the 10 moving average. This is not good for Tron though. Tron is volatile, but this. Let's go see 50-minute charts. Bearish engulfing candle down here, right below the support. Some kind of channel up here, maybe. It looks like a nice channel though. Yeah, it's not perfect, but it's a nice channel. Maybe right now at the upper side of the channel. Maybe if it gets up there, we might, short again. But we had already bearish engulfing candle up here, but you never know. Maybe it tries another one and then we can short. But I don't want to short anything because Bitcoin right now is Bitcoin. Uh, 12 minutes until the meeting, guys. Wish I could get ARA cheaper. Best YouTuber, period. Hit like, guys. Yeah, hit like button if you haven't hit like button. Smash the like button if you want the Bitcoin price to go up. If you want Bitcoin price to go up, right now it's time to smash the like button. You smacking the like button has direct impact on this candle over here, guys. And this candle is right now only 58 seconds left. The 55 seconds left for this candle. This like hits right now is affecting this candle in the positive way. So all the likes we can get right now pushes into this green candle, it pushes towards the upside. So if you want the price to go up, hit the like button, guys. You got like 38 more seconds. So much FUD, man, so much FUD. And I'm the only one when I'm saying that this is actually, good. 100 likes, 100k BTC, smash it. I'm going to smack the like button. I don't want it to go up now. Okay, wait like 5 seconds left and then you can smack it. I'll hit like 2 times. There we go. You're getting some kind of green candles up here towards the upside. This is gonna bite so hard, man. This is gonna bite so hard. This you know, up down move, you know, zigzag move. This is like get that, you know. This is like, yeah. What are you gonna say? This is like, you know, remove everybody out of the market and then, you know, choose direction. You know, oftentimes, you know, these moves, big up down moves, you know, they do happen. But I think this is gonna go towards the upside. You know, even when we went down, I was still saying this is gonna go towards the upside. Because this FOMC meeting, I think, because number one, 0.75 is priced in. It's been priced in for a long time. They've been talking about 0.75, and I think a lot of people already know. So the market already priced that in. Somewhere, somebody knew. Somebody's mom, somebody's girlfriend, somebody's friend, somebody knew, and they told somebody during something, and somebody knew. You know, sent that, you know, information, you know, on and on and on. Somebody knew, guys. Somebody knew. And the big guys that are moving the markets, they definitely knew from somebody else. And those big guys start moving in the market. And these little guys that are following the big guys figured out, hey man, they're doing something. And the last time did that happen. So they are also pricing it in based on what the big guys are doing. The guys that know that somebody is doing something. And, you know, there is a whole chain reaction up here. So the market's priced in already 0.75. What they did not price in is what he's going to say in the speech. Maybe that's also priced in, but you know, I don't know. That should also be priced in. Because somebody had to, you know, write the speech. Bitcoin has 3 million. 3 million where? Final checkout. See here, we came into this resistance up here right now, and you know, try to break it right now, but you know, we're coming very closer. So we got still 21 more minutes left, guys. What we're gonna do right now is we're gonna take 5-minute break. We're gonna come back, and then you know, hopefully the FOMC meeting will start. We'll watch it live, and then we'll, you know, comment during, you know, and see if the price actually, you know, goes up and down in Celsius. Oh man, that's bad. But I don't know. Can he take it out? Can he get out his money? Because Celsius is not actually doing that bad. The speech is always made to smooth the markets. It's not for. But number one, if the 0.75 is priced in, and if this speech is there to smooth markets up, then this price should pump towards the upside, right? He didn't get it out. Oh. But he cannot get it out at all. Bitcoin, the 3 million. I think it's gonna pump. I'm still bullish, no problem. They said that he has to put more in to take out the money. What kind of crazy stuff is that? You have to put more in to take out the money. It was the speech last time that made the pump. You no, speech made it dump, didn't it? Yeah, speech made it pump. 3 million is true. Yeah, Bitcoin is like something between 10 and 20 million. You know, I don't know, his company or whatever. Ponzi scheme. The more I read about these DeFi, you know, DeFi coins and stuff like that, the more it sounds like the, you know, Ponzi scheme. So it was a big, huge Ponzi. DeFi was a big, huge Ponzi, guys. You know, because when you put in, you know, you put in your dollars and then you get more dollars back, and they just print the dollars out because, you know, oh, we are right now, you know, the printing machine, and they give you, you know, 20-30% API. Like it's somewhere, you know, somewhere something is gonna, you know, it's gonna click somewhere, something, you know. So I'm not quite sure about that, you know, how they can give you 20-30% returns, but you know, there's that. They need to make money somewhere. Maybe if you had a trading bot and you said, you give me your money, we'll trade that money and you get return back. So, you know, you get like, you know, if our profit on the trading is like 20%, we're gonna guarantee you're gonna get like 5%, you know, API on your profits. Like that's not, you know, then you got some kind of business that generates profits and then you take those profits to give back. But I don't know what they have been generating though. Mental fire break. Okay, fast quick break. Okay, there we go. This one up here. You still haven't started. I hope it sounds okay. Where's the music? There is no music. We're expecting FOMC meeting. Now it's coming very close. There we go. Tell me if the sound is too loud.
I will begin with one overarching message. We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 of a percentage point and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections.
I think unexpected news will...
Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food, and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%.
Hint of it. There we go.
We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common.
Oh, that's good.
From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can.
Volatility is kicking in.
Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Question and answer is going to be interesting, though.
Thank you. Howard Schneider with Reuters.
Undecisive.
Two related questions. Chair Powell, Did you
Sam,
feel
on the
you
other hand, look at
boxed
it,
yourself
man.
in with the
They got
language you
stopped
used
out.
at the last press conference on 50 basis point hikes in June and July? And would you please give us as detailed a sense as you can of what role you played in reshaping market expectations so quickly on Monday?
So, as you know, we always aim to provide as much clarity as we can about our policy intentions, subject to the inherent
nothing
uncertainty in
unexpected.
the
That's
economic
good.
outlook, because we think monetary policy is more effective
That's why it's
when
gonna
market
come.
participants understand how policy will evolve, when they understand our objective function, our reaction function. And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook.
Look at the price.
So,
Look at the price.
and I think over the course of this year, financial markets have responded and have generally shown that they understand the path
Everything goes green,
we're
guys.
laying out.
Everything goes green.
Of course, it remains data dependent, and so that's what we generally think about guidance, and that's why we
Targets.
offer it. And of course,
Oh,
when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that if the economy performed, if data came in worse than expected, then we would consider moving even more aggressively. So
Again,
we
again.
got the CPI data and also some data on inflation expectations late last week, and we thought for a while, well, this is the appropriate thing to do. So then the question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer
Okay, good.
is that's not where we are with this. So we decided we needed to go ahead, and so we did. And that's really how we made the decision.
Gina?
Thanks for taking our questions. Gina Smilik with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have? And why not just go for a full percentage point at some point?
Sure. So if you take a step back, what we're looking for
Good
is
question.
compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the upside. Some indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up expeditiously to more normal levels, and we came to the view that we'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, in that range in that more normal range, and that's a desirable place to be because you begin to have more optionality there about the speed with which you would proceed going forward. Just talking about the SEP for a second, what it really says is that committee participants widely would like to see policy at a modestly restrictive level at the end of this year. And that's 6 months from now. And so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are. And that's what they want to see, knowing what they know now and understanding that we need to be we need to show resolve, but also be
Guys, be
flexible
careful
to
with
incoming
FOMO.
data as we see it. If things are better, we don't need to do that much. And if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent. Then you're looking at next year, and what you're seeing is people see a bit more tightening in a range of maybe 3.5% to 4%. And that's generally what people see as the
Everything
appropriate
green, guys.
path
Everything green.
for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seem like the right thing to do at this meeting, and that's what we did.
Steve.
200%. guys,
Steve Leisman,
200%.
CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee
We didn't
is
get 200%,
projecting
guys. We got
4%
stopped out.
or 3.8% next year in terms of the funds rate, which is similar to where the market is now,
No,
the
follow the
futures
rules,
market,
guys.
a 4% funds rate next year. Do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive, and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5% to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid twos. You can look, frankly, at broader financial conditions. You can look at, asset prices. You can look at the effect you're having on the economy, rates, asset prices, credit spreads. All of those things go into that. You can also look at the yield curve and ask all along the yield curve, where is the policy rate? So for much of the yield curve now, real rates are positive. That's not true at the short end. At the short end of the yield curve in the early years, you don't have you have negative rates still. So that really is one data point. It's one part of financial conditions. So I think I have to look at it this way. We move the policy rate, that affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see, demand moderating. Demand is very hot still in the economy. We'd like to see the labor market getting better in balance between supply and demand. And that can happen both from supply and demand. Right now, demand is substantially higher than available supply, though. So we feel that there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't affect, and those would be, the things, the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still, pushing upward on inflation. So that's really how I would think about it.
But does 3.8%, 4% get it done? Does it get the job done and breaking the back of inflation?
I think it's certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean, honestly, that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days, so I would think it would. But you know what? We're going to find that out empirically. We're not going to be completely model driven about this. We're going to be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
Thank you, Nick.
Thanks. Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data, but I'm wondering, on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
So if you look at we look at a broad range of inflation expectations. So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that expectations are still in the place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look for most measures, most of the time, that's what you see. If we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised nonetheless. It was quite eye-catching, and we noticed that. We also noticed that the index of common inflation expectations at the board has moved up after being pretty flat for a long time. So we're watching that, and we're thinking, this is something we need to take seriously. And that is one of the factors, as I mentioned, one of the factors in our deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI reading.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
You know, I'll just say we're going to react to the incoming data, and appropriately, I think. So I wouldn't want to put a number on what that might be. The main thing is to get rates up, and then pretty soon we'll be in an area where we're, I think, as you get closer to the end of the year, you're in a range where you've got restrictive policy, which is appropriate. 40-year highs in inflation. We think that policy is going to need to be restrictive, and we don't know how restrictive. So I think that's how we'll take it.
Insane moves. Ethereum 17% up since the.
Hi, Chair Powell. Neil Irwin from Axios. Thanks for taking our questions. The
Pullback is
late-breaking
normal
kind of
after
decision to go to
the
75 basis points, do you worry that will make policy guidance a less effective tool in the future? And should we think of that as a kind of symmetrical reaction function if we start to get soft readings on inflation, or if the labor market starts to roll over?
To take your second question first, yes. I mean, I think we're resolved to take this on, but we're going to be flexible in the implementation of it. Sorry, and your question was guidance. So again, the overall exercise is that we try to provide as much clarity about our policy intentions as we can, because we think that makes monetary policy work better. It's always a trade-off, because you have to live with that guidance. And so you do it, and it helps a lot of the time. I frankly think this year has been a demonstration of how well it can work. With us having really just done a very little in the way of raising interest rates, financial conditions have tightened quite significantly through the expectations channel, as we've made it clear what our plans are. So I think that's been a very healthy thing to be happening. So, and I would hope that it's always going to be any guidance that we give is always going to be subject to things working out about as we expect. And in this particular situation, we're looking for something specific, and that is progress on inflation. We want to see progress. We want to see inflation can't go down until it flattens out, and that's what we're looking to see. And if we don't see that, then that's the kind of thing that will cause, even if we don't see progress for a longer period, that could cause us to react. But we will soon enough. We will be seeing some progress at some point, and we'll react appropriately to that too. But I would like to think, though, that our guidance is still credible, but it's always going to be conditional on what happens. This is an unusual situation to get, some data late during blackout, very close to our meeting. Very unusual to one that would actually change the outcome. So I've only seen, in my 10 years plus here at the Fed, I've only seen something like that, even close to that, 1 or 2 times. So I don't think it's something that'll come up a great deal.
Colby.
Thank you so much for taking our questions. Colby Smith with the Financial Times. On the clear and convincing threshold for the inflation trajectory, what is the level of realized inflation that meets that criteria? And how is the committee thinking about the potential trade-off of much higher unemployment than even what's forecasted in the SEP if inflation is not moderating, at this acceptable pace?
Sorry, the second part I didn't get.
What's the potential trade-off with higher unemployment than even what's forecasted in the SEP if inflation is not moderating at an acceptable pace?
Right. So what we want to see is a series of declining monthly readings for inflation, and we'd like to see inflation headed down. So, and right now our policy rate is well below neutral, right? So, soon enough we'll have our policy rate. Let's assume the world works about like the SEP says. The policy rate will be up where we think it should be, and then the question would be, do you slow down? Does it make you, you'll be making these judgments about, is it appropriate now to slow down from 50 to 25, let's say, or speed up? So that's the kind of thinking we'll be doing, and we're looking, ultimately, we're not going to declare victory until we see a series of these, really see convincing evidence, compelling evidence that inflation is coming down. And that's what I mean by, that's what it would take for us to say.
So there is a lot of optimism in his
about
speech about inflation will be coming down a couple of years. This
because
is necessary.
we saw last year,
Everything is expected.
Inflation came down over the course of the summer and then turned right around.
What
and
he's
went
not
back up.
focusing on is the
So I
balance
think we're going to
sheet.
be careful about declaring victory.
Do people know about balance sheet,
Again, the
man? Tell
implementation
people
of
about
our
balance
policy is
sheet.
going to be flexible and sensitive to incoming data.
Are you more concerned now that to bring down inflation, it's going to require more than just some pain at this point?
Nice, Captain, nice.
So again, I think that I do think that their objective, and this is what's reflected in the SEP, but our objective really is to bring inflation down to 2% while the labor market remains strong. I think that what's becoming more clear is that many factors that we don't control are going to play a very significant role in deciding whether that's possible or not. And there I'm thinking, of course, of commodity prices, the war in Ukraine, supply chain, things like that, where we really can't, the monetary policy stance doesn't affect those things. So, but having said that, there is a path. There's a path for us to get there. It's not getting easier. It's getting more challenging because of these external forces, and that path is to move demand down, and you have a lot of surplus demand in take for example in the labor market. So you have two job vacancies essentially for every person actively seeking a job, and that has led to a real imbalance in wage negotiating. You could get to a place where that ratio was at a more normal level, and you would expect to see those wage pressures move back down to a level where people are still getting healthy wage increases, real wage increases, but at a level that's consistent with 2% inflation. So that's a possibility, and you could say the same thing about some of the product markets where there's just excess capacity. And where the strong demand has gone into where they're capacity constrained, right? So you have effectively what we think of as a vertical supply curve or close to it. So demand comes in and it's very strong, and it shows up in higher prices, not higher quantities, not more cars, because they can't make the cars because they don't have the semiconductors. So in principle, that could work in reverse. When demand comes down, you could see, and it's not guaranteed, but you could see prices coming down more than the typical economic relationships that you see in the textbooks would suggest because of the unusual situation we're in on the supply side. So there's a pathway there. It is not going to be easy, and again, it's our objective, but as I mentioned, it's going to depend to some extent on factors we don't control.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. So the new projections show the unemployment rate ticking up through 2024. Is a higher unemployment rate necessary in order to combat inflation? And what is lost if the unemployment rate has to go up and people lose their jobs in order to control inflation? Thank you.
So You're right. In the SEP, we have unemployment going up to 4 point. The median is 4.1%. There are, of course, a range of actual forecasts, and I would characterize that if you were to get inflation down to, on its way down to 2%, and the unemployment rate went up to 4.1%. That's still a historically low level. We hadn't seen unemployment rates below 4% until a couple of years ago. We'd seen it for like 1 year in the last 50. So the idea that 3.6% is historically low in the last century. So a 4.1% unemployment rate with inflation well on its way to 2%, I think that would be I think that would be a successful
4% is actually fine.
So
in Boston,
we're
it's
not
like
looking
30%
to have a higher
unemployment rate.
unemployment rate, but I would say that I would certainly look at that as a successful outcome.
Does that include people losing their jobs, or?
We don't seek to put people out of work. Of course, we never think too many people are working and fewer people need to have jobs. But we also think that you really cannot have the kind of labor market we want without price stability. And we have to go back and establish price stability so we can have that kind of labor market. And that's a labor market where where workers are getting wage increases. Maybe the workers at the lower end of the spectrum are getting the biggest wage increases, as they were before the pandemic, where participation is high, where there's lots of job opportunities, where it's just the labor market we had before the pandemic that's what we want to get back to. And you see
what is an exit short signal?
Disparities between various groups at historic lows. We'd love to get back to that place.
What is your box?
But to get there, it's not going to happen with the levels of inflation we have. So we have to restore that, and it really is in service in the medium and longer term of the kind of labor market we want and hope to achieve.
Hi, Chair Powell. Matthew Bosa with
Every
Bloomberg.
phone committee.
So, as you just mentioned, the committee is now projecting a 0.5 percentage point rise in the unemployment rate and the SEPs over the next couple years, and it removed a line from its policy statement about thinking that the labor market can remain strong while it tightens policy. You just mentioned that that is still your objective, though, so I'm wondering if you could explain why that line was removed from the statement, and also whether this means the FOMC is trying to induce a recession now to bring inflation down.
We're not trying to induce a recession now. Let's be clear about that. We're trying to achieve 2% inflation consistent with a strong labor market. That's what we're trying to do. So let me talk about that sentence. Clearly, it's our goal to bring about 2% inflation while keeping the labor market strong, right? And that's kind of what the SEP says. That the SEP has inflation getting down to a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market. And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger and longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. It just didn't, the sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate, so we took the sentence out.
And given the new projections for the unemployment rate, could you talk a little bit about what accounts for such reduced confidence against, say, a month ago or 3 months ago, that inflation will largely normalize on its own as these supply side issues get worked out? Thanks.
Well, yeah, I think you've seen, again, we've been expecting progress, and we didn't get that. We got sort of the opposite. So I also think the situation, really since the consequences of the Ukraine war become more and more clear, what you're seeing is the situation getting more difficult. And you look around the world, I mean, lots of countries are looking at inflation of 10%. And it's largely due to commodities prices. But all over the world, you're seeing these effects. And so, and we're seeing them here. Gas prices, all-time highs and things like that. That's not something we can do something about. So that is really, and by the way, headline inflation is important for expectations. The public's expectations, why would they be distinguishing between core inflation and headline inflation? Core inflation is something we think about because it is a better predictor of future inflation. But headline inflation is what people experience. They don't know what core is. Why would they? They have no reason to. So expectations are very much at risk due to high headline inflation. So it's become, the environment has become more difficult, clearly, in the last 4 or 5 months. And hence the need for the policy actions that we took today, hence our resolution to, to get rates up and ultimately get them to where we think they need to be in coming months.
Thanks, Chair Powell. Edward Lawrence with Fox Business. I want to ask you, you talked about CPI going to 8.6%. The retail sales surprised the market by falling, and then revisions to the previous months were down. Are you hearing from contacts about consumers slowing spending or changing their habits?
So we're, of course, watching very, very carefully for that, and looking at the retail sale, the big store numbers and all that kind of thing. And so, but I think the fair summary of what we see is you see continuing shifts in consumption. You see some things sales going down, but overall, spending is very strong. The consumer's in really good shape financially. They're spending. There's no sign of a broader slowdown that I can see in the economy. People are talking about it a lot. Consumer confidence is very low. That's probably related to gas prices, and also just stock prices to some extent for other people. But that's what we're seeing. We're not seeing a broad slowdown. We see job growth slowing, but it's still
see
at
a
quite
broad
robust
slowdown
levels.
in the economy?
We see the economy slowing a bit, but still
money?
growth levels, healthy growth levels.
So then as you are raising rates in this economy, how closely are you watching consumer spending, or is there another indicator that you're watching more closely?
It would be hard to watch anything much more closely than we watch consumer spending, but we watch everything. We watch business fixed investment, which actually has softened a bit, and we watch. We're responsible for watching everything, but consumption is 60-some% of the economy, 2/3 of the economy. So naturally, we spend a lot of time on that. And again, there's a lot going on. There are a lot of flows back and forth, but ultimately, it does appear that the U.S. economy is in a strong position and well positioned to deal with higher interest rates.
Thank you, Mr. Chairman. Michael McKee from Bloomberg Radio and Television. Are you targeting headline inflation now or core inflation? In other words, how far would you chase oil prices if they keep going up, if that's going to be the component that drives expectations? Would you risk recession for a headline rate if the core rate is holding steady or starting to go down?
So we're responsible for inflation in the law, and inflation means headline inflation. So that's our ultimate goal. We, of course, like all central banks do, look very, very carefully at core inflation because it's a much better predictor, and it's a much better predictor of where inflation is going, and it's also more relevant to our tools. As I mentioned, the parts that don't go into core are mostly outside the scope of our tools, so we look at that. But the current situation is particularly difficult because of what I mentioned about expectations. We can't affect. Really, I mean, the energy prices are set by global commodity prices, and most of food, not all of it, but most food prices are pretty heavily influenced by global commodity prices too. Also, other things. So we can't really have much of an effect, but we have to be mindful of the potential effect on inflation expectations from headlines. So it's a very difficult situation to be in, and we can't do much about the difference between the elements that make up headline that are not in core.
Could I just, as a follow-up, get a clarification on the SEP? When the members gave their forecasts, when were they inserted into the record? Were they revised after the CPI or Michigan numbers came out? In other words, does the SEP as we have it now reflect the same factors that led you to go to a 75 basis point
What?
move.
The SEP is of one
Stream is
piece.
fine.
From Politico. I wanted to ask about how you're measuring progress, especially since you've now started front-loading rate hikes more. You've talked about how you want to
Just
see
reload the
inflation
stream,
coming
guys.
down over a series of reports. And I guess I'm curious whether you think inflation data itself is a really good indicator, or whether you might be concerned that it's a lagging indicator, or that it might send confusing signals, given that, as you've talked about, there are sort of supply and demand aspects. And I guess my question is, do you think that inflation data will tell you when you've gone to where you need to go, or do you just feel like maybe it's better to overshoot than to undershoot?
So I think the role that we can play, maybe the way to get at it is to say that the role that we can play is around demand, right? So, and we'll be able to see the areas that we can affect are those that are associated with excess demand. And we'll be able to see our effect on, for example, job openings in real time. So, and that would tell us about wages. Wages are not principally responsible for the inflation that we're seeing, but going forward, they would be very important, particularly in the service sector. So, sorry, I'm not sure I'm getting to your question.
My question is inflation data itself the best indicator for when you're getting to where you need to go, or might it lead you to go too far?
There's always a risk of going too far or going not far enough. And it's going to be a very difficult judgment to make, or maybe not. Maybe it'll be really clear. But we're quite mindful of the dangers. But I will say the worst mistake we could make would be to fail, which it's not an option. We have to restore price stability. We really do. Because everything, it's the bedrock of the economy. If you don't have price stability, the economy is really not going to work the way it's supposed to. It won't work for people. Their wages will be being eaten up. So we want to get the job done. This inflation happened relatively recently. We don't think that it's affecting expectations in any kind of fundamental way. We don't think that we're seeing a wage price spiral. We think that the public generally sees us as very likely to be successful in getting inflation down to 2%, and that's critical. It's absolutely key to the whole thing that we sustain that confidence. So that's how we're thinking about it.
Hi, Brian Chung with Yahoo Finance. I just want to expand, I guess, on what you just said now about the general public feeling like you can get this done. When you talk about consumer sentiment being down, household inflation expectations being up, recession just broadly being dinner table talk, does the general feel among American households and also businesses square with your explanation of the economy, given that the description of inflation in the statement didn't change between May and June? Thanks.
So clearly, people don't like inflation a lot, and many people are experiencing it really for the first time, because we haven't had anything like this kind of inflation in 40 years, and it's really something people don't like, and they're experiencing that, and that's showing up in surveys and in all kinds of ways. And we understand that, and we understand the hardship that people are experiencing from high inflation, and we're determined to do what we can to get inflation back down. So that's really what we're saying. Clearly, it's an incredibly unpopular thing, and it's very painful for people. So, but I guess what I'm saying is the question, really critical question from the perspective of doing our job, is making sure that the public does have confidence that we have the tools and will use them, and they do work to bring inflation back down over time. It will take some time, we think, to get inflation back down, but we will do that.
Chris.
Thank you. Chris Rugaber at Associated Press. You have talked about inflation a few times and mentioned oil prices, China lockdowns. But aside from
too many questions,
in commodity prices such as gas prices, we're also seeing stickier measures of inflation increasing, such as the Cleveland Fed's median and trimmed mean CPIs. I mean, how persistent do you see those underlying measures of inflation, and how do you expect to, and where do you see those going in the near future?
So, as I mentioned, I think in my opening statement, the inflation has started off in quite narrow, very directly pandemic-related areas, and it's spread now broadly across the economy and into the services sector as well. It was really in the goods sector at the beginning. In particular, you're seeing in travel now, if you've flown on a plane lately, planes are very full and plane tickets are very expensive. Some of that will be passed through of energy prices, but it's you're experiencing services inflation. Shelter inflation is high. So, so the question, and you see the Cleveland measure going up, and many other measures are going up. So it's a time when we're not seeing progress, and we want to see progress, and that's really another part of why we did what we did today, and why the SEP looks like it does, is that we see it as appropriate to get the policy rate up to restrictive levels, which would be, in the thinking of the committee, somewhere in the range of 3 to 3.5% by year end, and then after that, you see what the rest of the SEP says. So I hope that's responsive to your question.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Do you still think a softish landing is possible, and how would you define that at this point, considering the revised projections for unemployment, GDP, inflation?
So I think what's in the SEP would certainly meet that test. If you see, you're looking at getting back down to almost a 2% inflation by 2024, and the unemployment rate is still as low as 4.1%. That would be, I would call that as meeting that test. Do I still think that we can do that? I do. I think there's. I don't want to be the handicapper here. That is our objective. And I do think it's possible. Like I said, though, I think that events of the last few months
he didn't say actually
have
much. He
raised
avoided
the
the recession stuff.
Created great
He
challenges.
avoided the balance
again,
sheet. He was just
the
talking
answer
about
to
how
the question,
the inflation
can we
is.
still
You know,
do it?
we're gonna get it down. Below 2%
there's a much bigger chance now
in
that
a
it'll
couple of
depend
years.
on
He
factors
didn't
that we
actually
don't
say
control,
nothing.
which
That we
is,
didn't know. But
fluctuations and
we can
spikes
read
in
between the
commodity
lines.
prices
So
could
he's not saying what
wind
kind of
up
effect
taking
these
that option out
hikes
of our
rates are
hands.
having.
So
On
we
the
just don't
broader
know, but
economy.
we're focused on
what's gonna happen
very,
with
very
housing
focused
markets
on
now
getting
that rates are going
inflation
up?
back down to 2%.
Are we gonna have 2008 crash
which we
all
think
over
is
again there?
For the
And
benefit
so
of the
forth, so
public,
forth.
and
So he's
also
just,
to put us on a path
talking about the
back to a
inflation, but
strong labor market like the one we had before the pandemic.
Your rates are not affecting inflation. It's it's affecting the entire economy. So
Thank
and all
you.
the questions
Greg
are
Roth from
related to
MarketWatch.
inflation.
Chair Powell, I was wondering if you could talk a little bit more. Economists are worried that you're kind of hitting the economy with a sledgehammer, and that now there's even more risk of a recession than a 50-50 path of rates. So could you talk a little bit more about that, and what evidence would get you to stop rate hikes and maybe even reverse them?
Sure. So
this is going to dump the market.
As I mentioned, financial conditions have tightened over the last 7 months, and that's a good thing, we think. But the federal funds rate, even after this increase, is at 1.6%. So it's hard to see how that is too high of a rate. And even if we did another, we're going to get here by the end of the summer somewhere in the 2s probably. Still, that's still a low rate. So that's not a rate that is calculated to bring a recession on. And by then we'll have seen a whole lot more data. As I mentioned a couple times, the committee's views are around a modestly restrictive stance, which would be in the 3 to 3.5% range by the end of this year. But that's conditioned on that being the appropriate thing to do. If we see data going in a different direction, it'll be reflected in our policy, as you see today. We'll be watching if things go in a direction we don't expect, then we're going to adapt. And I would say this is a highly uncertain environment, extraordinarily uncertain environment. So. Again, we'll be determined and resolved, but flexible.
Okay, Evan.
Evan Reiser, Market News International. Thank you, Chair Powell. I was wondering if the Fed has initiated a review of the conduct of monetary policy over the last 2 years or so, given the inflation, and will that be shared with the public?
And then secondly, given the illiquidity and extraordinary volatility in financial markets, are you concerned that QT will make that worse?
Sorry, what was your question on QT?
Just given the illiquidity and extraordinary volatility in financial markets, whether QT will make things worse.
So, of course, we've been looking, very carefully and hard at why inflation picked up so much more than expected last year and why it proved so persistent. It's hard to overstate the extent of interest we have in that question, morning, noon, and night. So, but you have to understand the context. Really, the context is this: for decades before the pandemic and the reopening, you had a world where inflation was dominated by disinflationary forces such as declining population or aging demographics, let's call it that, globalization enabled by technology, other factors, low productivity. So, and that's how all the models work. Is decades and decades of data. They look at that. It's a very flat Phillips curve work, and the supply shocks tend to be transient, right? So we have now experienced an extraordinary series of shocks, if you think about it. The pandemic, the response, the reopening, inflation, followed by the war in Ukraine, followed by shutdowns in China, the war in Ukraine potentially having effects for years here. So we're aware that a different set of forces are driving the economy. We have been, obviously, for quite a while, that these forces are different. Inflation's behaving differently. And in our thinking, it really is a question of very strong demand, but you couldn't get this kind of inflation without a change on the supply side, which is there for anybody to see, which is these blockages and shortages and people dropping out of the labor force and things like that. So that's how we're looking at it. And we've done a lot of work internally on and thinking about what all that means. The thing is, you don't know whether those forces are, what extent are they going to be sustained? In other words, will we go back to a world that looks a little more like the old world, or are we really going to be in a world where major supply shocks go on and on? The history is you see these waves of supply shocks, as you did in the 70s, and then they go away, and sort of there's a new normal and things settle down. But honestly, we don't know what that's going to be. In the meantime, we have to find price stability in this new world and maximum employment in this new world where clearly inflationary forces you're seeing them everywhere. Again, if you look around the world at where inflation levels are, it's absolutely extraordinary. It's not just here. In fact, we're sort of in the middle of the pack. Although I think we have, of course, a different kind of inflation than other people have, and partly because our economy is stronger and more highly recovered. So that's what we're doing. We've done a lot of introspection and work on that. And sorry, on QT,
finally,
we've communicated really clearly to the markets about what we're going to do there. Markets seem to be okay with it. We're phasing in. Treasury issuance is down quite a lot from where it's been. So I have no reason to think, markets are forward-looking and they see this coming. I have no reason to think it will lead to illiquidity and problems. It seems to be kind of understood and accepted at this point.
Thanks. For the last question, we'll go to Mark Hamrick.
Mr. Chairman, Mark Hamrick with Bankrate. Wonder what your assessment is about the outlook for the housing market, given the years-long increase in home prices and now the sharp rise in mortgage rates. And all that, of course, given the heightened sensitivity around the housing market, given the fact that it was a trigger for the great financial crisis over a decade ago. Thank you.
Sure. So rates were very low. A good place to start is that rates were very, very low for quite a while because of the pandemic and the need to do everything we could to support the economy when unemployment was 14% and the true unemployment rate was well higher than that. So, and that was rates are low, and now they're coming back up to more normal or above levels. So in the meantime, while rates were low and while demand was really high, obviously demand for housing changed from wanting to live in urban areas to some extent to living in single-family homes in the suburbs, famously, and so the demand was just suddenly much higher, and so we saw prices moving up very, very strongly for the last couple of years. So that changes now, and rates have moved up. We're well aware that mortgage rates have moved up a lot, and you're seeing a changing housing market. We're watching it to see what will happen. How much will it really affect residential investment? Not really sure. How much will it affect housing prices? Not really sure. It's, obviously we're watching that quite carefully. You would think over time, so there's a tremendous amount of supply in the housing market of unfinished homes. And as those come online, whereas the supply of finished homes, the inventory of finished homes that are for sale is incredibly low, historically low. So that it's still a very tight market. So prices may keep going up for a while, even in a world where rates are up. So it's a complicated situation. We watch it very carefully.
So
I
instead,
would
we are
say
not
if
going to
you're,
get a
if you're a
market
home
crash.
buyer,
Stock,
somebody or a
housing
young
market
person
crash.
looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together, and where inflation is down low again, and mortgage rates are low again. So this will be a process whereby we ideally we do our work in a way where the housing market settles in a new place, and housing availability and credit availability are at appropriate levels. So thank you very much.
I remember. There we go. That's it. And right now this is starting going towards the upside. This is pretty much done. Over here, just make this a little bit bigger up here and put it up there where it should be. There we go, and we can minimize it. So right now over here we can actually talk about what has actually happened. Supermoon is pumping us. We got a supermoon. Actually it was yesterday, but today is probably hitting us right now. I was expecting a move towards the upside. We did get moved towards the upside. I didn't know how big move towards the upside, but we are breaking this trend up here, guys. We are breaking the trend up here. There is a trend line up here. Let's just see this on the 1 hourly time frame. You can see the very important trend line. Right now we are finally breaking that on this hourly time frame. So right now down here was best kind of entry position. Technically down here was best entry position, right? And we actually had a long from over here. If you see on the sand down here, we actually managed to long right over here, but unfortunately this week right now got us out. So we lost on our trade, and this trade went all the way up there like 90%. So we could have 19% times 10, so 200% long trade on 10x towards upside. Unfortunately that didn't play out. We got wicked out. We're gonna work on these stop losses. We're gonna work on the moves towards the these big moves. But so I don't think FOMC meeting has actually he didn't say anything special about recession, about what they're gonna do with the balance sheet. He mentioned a little bit about stock market and stuff like that, about printing QE and stuff like that. But I think everything was kind of expected in a way that it's gonna be 0.75. We know that it's gonna continue 0.75. We know that. He also said they're gonna try to get inflation down to 2% over a couple of years. Unemployment market is okay. Everything is kind of okay. He said everything and nothing. Exactly, he said everything and nothing because everything that's what the people have been talking about. So based on that, and I was kind of expecting that. I was expecting that these news are not gonna be any way, shape or form bearish, because only way this can actually dump right now is if he sees come out and said okay, 1 percentage points we are rising this towards upside, and we kind of already had rumors that he's not gonna do that. It's gonna be 0.75, what is expected. And right now that is coming, this is most likely gonna pump. Why? Because we are at the bottom, guys. When we talk about technicals when it comes to Bitcoin, we already see it we are bottom. DXY was actually hitting the top up here, so we are expecting some kind of, you can see even we called some kind of top, intermediate top, maybe. I don't know what kind of top it is gonna be up here on the daily time frame. So we called this top up here, and right now we are pulling on the downside as well. And DXY is going towards downside. Stock markets is also on some kind of support level on the downside. So both Bitcoin and stock markets are on the bottom, while DXY is going down. FOMC meeting is coming up. It's gonna be, you know, expected, and expected is bullish in these kind of environments. So I was kind of expecting this to move towards the upside. Unfortunately, not much said, but we might get relief rally if and only if we manage to break close above this line up here. We still got 30 minutes left for that. So you can see here we did close below the line up here. This is a very important trend line up here. Very, very important trend line. Right now we are just below below the trend line up here, and we are trying to get above this 50 moving average. If we close here above the 50 moving average, I would think that market is gonna go, you know, way higher, and this is gonna continue going towards the upside. That might be very good for Alcon. So I might, you know, look for some kind of trade on something, but I'm not quite sure about that. Anyways, guys, right now it's yeah, that said, I'm also not very interested in trading this right now. You know, it's too much volatility, it's too much, you know, too much work, but you know, the volatility is huge and people like volatility. I don't actually like volatility when I need to enter a trade. I actually like, you know, calm markets. I need, you know, to see some kind of patterns, to see some kind of normal movements, to see some kind of, you know, something happening nicely. And well, let me just see here on the 5-minute chart up here. So look here, this looks like the same pattern like over here, you know, right up, down, and up over here, then a little bit down and then up. So this up, down, a little bit up, a little bit down, and then up. So if this comes back to the line, you know, again up here, maybe that's gonna blast towards upside. This looks like, you know, it might drop a little bit down to these moving averages and then continue towards, just so you know that, guys. But the volatility is pretty high. The volatility is pretty high. Happy about ADA 044 and sold half a moment ago. Yeah, ADA pumped big time, 8% towards the upside. Unfortunately, our long trade didn't go that well. But I'm actually happy about our trade, guys. Believe it or not, I'm very happy about our trade, even though we got only like, you know, what is that? Like 0.7%. 0.75%, you know, on the profit, where we could have gotten like, you know, 200% towards upside. And the reason I'm happy is because everything worked out as I actually expected to work out. From the bottom down here to these moves towards the upside up here, you know, to hitting the first resistance up here. On the pullback, I did not sell anything because I was still expecting this move towards the upside up here, and I was expecting that we can actually hit. I did not expect that I'm gonna get stopped out, and this came very close, and maybe even a bigger pullback than I expect. I expect doing something like this, then FOMC meeting, and then you know, all the way up there. So I thought this was a real probability. Unfortunately, we got a stop loss right over there, and I'm also glad that I did not remove the stop loss, guys, and I'm gonna tell you why. I could have removed the stop loss and put it down here, but I did that before, guys. Before, when I was, you know, very you know, didn't know how to trade, and you know, my TA wasn't that good, I did trade, and oftentimes I would see, you know, price goes, you know, with me, you know, I maybe buy here, price goes with me, I put some kind of stop loss, and price goes there, down there, and I was like, oh man, it's just gonna wick down and it's gonna get me out. So I would remove the stop loss, you know, and it would, you know, go below me my entry point. I was like, it's okay, it's gonna come right back down here, and it will go against me. So, you know, having the stop loss, if you decide for a stop loss, like, just leave it, like, find the next trade. Do not let your, you know, winning trades after the stop loss, you know, go into any kind of, you know, loss, even if you risk this over here. So even though we risked the move towards downside and getting you know, wicked out of the trade with a stop loss, it's okay. There will be new trades, guys. There will be new trades, and this is not the first trade that we are being, you know, wicked out of. You know, this has happened before. So let me show you up here. This has happened before, and let's see up here how this looks right now. Let's see how this looks right now. So over on this one up here. So you can see here we had a couple of trades up here, but this one short, it went minus 0.2, also wicked out, and we got wicked out on Theta short and sold short also. I don't remember if we got wicked out or not, but you know, we kind of get, but definitely Theta short, for example, minus 1.8%, we got wicked out, and you know, it went you know, hugely in profit after that. But it really doesn't matter. It really doesn't matter, because there will be new trades, guys. There will be definitely new trades, and you know, there will be another, you know, 200% gains and stuff like that. The most important thing is just, when it comes to trading, that we do not FOMO in on anything. We you know, always have a calm mind, very sharp mental state. We are well rested, we do the trade when we want to do the trade, not where market suddenly figures out, hey man, we're gonna, you know, do the volatility thing. So there is that. Okay, guys. Wow, it is pumping. Yeah, it is pumping. So Bitcoin right now, it is going a little bit towards the upside up here. I was expecting a pullback down here. No pullback, just right back up there. So this looks a little bit bullish, I think, especially if you break the right over here right now. This is gonna be very, very nice move towards the upside. And we've been saying that this break on the downside out of this channel, it was some kind of falling wedge or whatever we called it, break towards downside. The failure to that, we actually longed up here, right? We came with this wick on the dollar down here to the bottom, so some kind of double bottom down here right now, going above the resistance up here. This looks actually very bullish for a relief rally, guys. Very, very bullish for a relief rally. You also already see that altcoins are right now 10-20% towards the upside. Everything is pumping, and I think if we can close on the daily time frame is very important up here. No, it's 4-hourly time frame, sorry. If you can close the 4-hourly time frame up here a little bit above this resistance right up here, I think we can definitely rally, you know, both the 20 moving average, maybe even the 50. Nah, not 50 moving average, but you know, up to the 20 moving average, somewhere up here at the top. There is also a resistance up here as well. There, and then there's the 20 moving average, so 22.8, 23.3, something like that. It looks very possible. Very nice move towards the upside, no problem whatsoever. So you know, this looks very good, but we need to close this daily candle, of course. This is not daily candle, this 4-hourly candle. This 4-hourly candle needs to be closed, and this candle is going to be closed in 23 minutes. So it definitely, and 1-hourly candle is gonna might maybe close above this 50 moving average. So everything looks very good. This very channel over here right now is breaking to upside. So unless we just do some stupid dump right after that, I think we're gonna be okay, guys. I think we're gonna be okay. And you know, enjoy the green stuff. Unfortunately, there won't be any kind of more trading tonight. You know, it's getting a little bit late. We already did one trade. I'm very happy with the trade, because I'm telling you guys, it's not about money. Money will come. It's not about it. It's about being right. And I was right, you know, from the start to the end, and that makes me happy. So I know tomorrow we'll do another trade, maybe even a better trade. We're gonna get this to 100%, guys, one at a time. Maybe gonna stop out, you know, but we're gonna learn, you know, slow and carefully, and then we're gonna, you know, we're gonna make that 400 bucks into $1 million eventually. Subscribe to the channel if you're not subscribed. Hit the like button on the way out. Join the TF fans club. Join us. Nah, I'm not gonna shield the squad right now, but thanks everybody for stopping by. We just did a live stream just to watch what's gonna happen. Anyways, guys, cheers, and I'll see the rest of you guys in the Telegram chat. You know, I'm still awake, so you know. Okay, guys, bye bye.